All right, pause your scroll for a second, because something very real is happening in the silver market right now, and the timing matters. We just watched silver slide hard again, sitting near $81 to $82 an ounce, down roughly 33% from last week's $121.64 spike, and tonight the CME margin hikes go live, with silver margins jumping about 36%. That's not tomorrow. That's not next week. That's tonight. Both the CME's own notice and clearing member updates confirm it, and the result is urgent. Leveraged traders have hours, not days, to either post more cash or sell. Stay with me, because I'm going to show you why this move matters, how to recognize it next time, and what tonight's close could quietly decide. If you're holding silver right now, or if you've been watching from the sidelines waiting for clarity, you need to understand what's actually driving price action today. This isn't about fundamentals changing overnight. This is about leverage getting squeezed in real time. Before I explain what caused this specific move, let me teach you something most people don't really internalize about markets. Price doesn't just move on buyers and sellers arguing about value. A lot of price action, especially in futures markets, comes from rules changing mid-game. Margins are one of those rules. Think of margin like the security deposit on a rental car. When the company suddenly triples the deposit, it doesn't mean the car is broken. It means fewer people can keep driving it. In futures markets, higher margins don't say demand vanished. They say leverage just got more expensive, and when leverage gets more expensive fast, people scramble. So what does that mean in practical terms? When you trade futures, you're not putting up the full value of the contract. You're putting up a fraction, the margin requirement. That lets you control a large position with relatively small capital. It's powerful when things go your way. It's brutal when they don't. And here's the key part. The exchange, the CME in this case, can change those margin requirements whenever they think the market is getting too volatile or too risky. They don't ask permission, they announce it, and traders have to comply. Now here's what you need to know about why today feels so compressed. When margins rise overnight, traders don't get the luxury of waiting for calmer conditions. They have to act into whatever liquidity exists right now. That's why you see sharp drops late in the session. It's not fear, it's math. If you're holding 10 silver contracts and the margin requirement just jumped 36%, you either wire more money immediately or you sell some contracts to bring your position back within compliance. And once you see that distinction, you stop panicking and start observing. You start asking, is this forced liquidation or is this a fundamental shift in the market? Those are very different things. If this is making sense so far, drop a comment below and let me know if you've ever been caught in a margin call situation. I want to hear your stories because that's how we all learn from each other's experiences. Now here's what's actually happening under the hood. Let me break down the sequence step by step because this matters. First, silver explodes higher in a short window, pulling in momentum traders, retail leverage, and short covering. That surge to $121.64 wasn't slow accumulation. It wasn't institutions quietly building positions over months. It was velocity. It was fast money chasing momentum. And when fast money comes in, it can leave just as quickly. You had people piling into silver futures, options, levered ETFs, all of it, all at once. Then the CME steps in and announces a roughly 36% margin increase, effective tonight. That's the primary driver. When that hits, every leveraged long has to reassess capital requirements immediately. Let's say you had $100,000 controlling $500,000 worth of silver. Suddenly, the exchange says you need $136,000 to hold that same position. Where does that extra $36,000 come from? For a lot of traders, it doesn't. They don't have extra capital sitting around, so they sell, they liquidate positions, not because they stopped believing in silver, not because the fundamentals changed, because the math changed. And here's where the mechanics get really important. This isn't one trader making one decision. This is hundreds or thousands of traders, all facing the same calculation at the same time. When they all start selling into the market within the same few hours, what happens to price? It drops. And as price drops, what happens to people who were barely meeting their margin requirements at higher prices? They fall below the threshold. Now they're getting margin calls too, so they sell. And that selling pushes price lower. And that triggers more margin calls. You see the cycle? Second, liquidity thins as the close approaches. That's the secondary confirmation. Fewer bids, wider spreads, more air pockets. During normal market hours, there are market makers and liquidity providers constantly quoting prices. But as you get closer to the close, especially when there's already volatility in the air, some of that liquidity pulls back. Market makers widen their spreads to protect themselves. So when forced selling begins, price doesn't gently adjust. It drops. Fast. There's no cushion. There are fewer buyers willing to step in at each level. That creates what traders call an air pocket. Price just falls through zones that would normally have some support. Third, you get narrative layering. Reports swirl about positioning at large banks like JP Morgan, temporary disruptions at the London Metal Exchange, and systems issues at HSBC. Whether or not there's coordination, the convergence of tighter margins, thin liquidity, and uncertainty matters. Together, they amplify pressure. Even if each individual factor is manageable, when they all hit at once, the combined effect is much larger. It's like three waves hitting the shore at the same moment instead of spread out over time. The impact multiplies. But here's the part that should make you nervous if you don't understand these mechanics. This kind of selling feeds on itself. A margin call forces selling. Selling drops price. Lower price triggers more margin calls. That's the cascade. It looks like a collapse, but structurally, it's liquidation, not a sudden rejection of silver as an asset. The metal didn't become less valuable overnight. The supply and demand fundamentals didn't shift dramatically in 24 hours. What shifted was the cost of holding leveraged positions. If you've ever watched chairs disappear in a game of musical chairs, you already understand this market. When the music stops, when the margin requirements change, some people are left standing without a seat. They have to exit the game. Now let me show you what very few people are talking about. The timing of these margin hikes is never random. Exchanges don't wake up one morning and decide to change margins for no reason. They do it in response to volatility. But here's the catch. The volatility that triggers the margin hike often happens on the way up. The spike to $121, that's what got the CME's attention. That's what made them say, we need to increase margins to protect the integrity of the market. But the actual hike takes effect after the spike, often when price is already coming down. So you get this perverse dynamic where the exchange is raising margin requirements right as traders are already losing money and already under pressure. It compounds the move. This is the exact same playbook we've seen before. Go back to 2011 when silver went parabolic and then imploded after aggressive margin hikes. I remember that move. Silver ran from around $30 to nearly $50 in a matter of weeks. It was euphoric. Everyone thought it was going to $100 to $200. And then the CME raised margins 5 times in 8 days. 5 times. Each hike made it more expensive to hold positions, and the first leg down was violent. Silver dropped from near 50 back to 35 in a matter of days. But here's what a lot of people forget. The second leg came after people thought it was safe again. After the initial washout, there was a bounce, a relief rally. People thought the worst was over. Then silver collapsed again, eventually dropping into the 20s and staying there for years. Or look at March 2020, across multiple assets, when margin stress forced selling into illiquid conditions. That wasn't just silver, that was crude oil going negative. That was gold dropping, even though everyone thought gold was supposed to be a safe haven. That was treasuries selling off when treasuries are supposed to be the safest asset in the world. Why? Because when traders face margin calls across their entire portfolio, they don't just sell what's down. They sell what they can. They sell whatever has liquidity. So even assets that should theoretically hold up during stress can get hit hard when there's forced liquidation happening across the board. Every time this happens, you get a sharp break, chaotic closes, and then a period where volatility slowly contracts before any real base forms. The pattern is consistent. Forced moves don't resolve in one day. They take time. The market needs to find a new equilibrium. Traders who got shaken out need to decide if they want to come back in. New buyers need to step up. That process doesn't happen overnight. Zoom out, and you see the pattern. Forced selling doesn't usually end in one clean day. It ends when the mechanical pressure exhausts itself. When everyone who was going to get margin called has already been margin called. When everyone who needed to sell has already sold. When the weak hands are out. Only then can price stabilize and potentially find a base. The larger story is this. Markets need time to absorb new rules. Tonight is one of those rule change moments. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be manipulation? Could big players be pushing prices around? Let me be honest. Claims about coordination make for great headlines. You see it all the time on social media, on forums. People saying the banks are suppressing silver, the big institutions are manipulating the market. There's a grand conspiracy to keep prices down. And look, I'm not going to sit here and tell you markets are perfectly efficient and fair. They're not. There are players with much deeper pockets and much better information than retail traders have. But here's the thing. You don't need a conspiracy to explain what you're seeing right now. Margin hikes alone are enough. The mechanics I just walked you through, those are real. Those are documented. The CME published the margin increase. It's not a secret. It's not hidden. Traders knew it was coming as of yesterday or the day before. So when you see price action that perfectly aligns with what you'd expect from forced liquidation due to higher margin requirements, why reach for more exotic explanations? Could there be additional factors at play? Yes. Could certain large players be taking advantage of the situation? Probably, but you don't need to prove a conspiracy to understand the trade. Focus on what you can actually verify. Margin levels, you can verify those. Price zones, you can see those on the chart. Volume behavior, that's right there in the data. Volatility, you can measure that. Those are real. Those you can act on. Everything else is noise until proven otherwise. And even if you could prove coordination, what would you do differently? You still have to manage your positions based on price action and risk management. You still have to decide whether to hold, whether to sell, whether to add. The conspiracy debate doesn't change that. There are probably 3 types of people watching this right now. Maybe you're holding silver and feeling blindsided. You bought into the move thinking it was going to keep running. Maybe you bought near the highs, or maybe you've been holding for a while and you're watching your gains evaporate. If that's you, I get it. It's painful. But your job isn't to predict the exact bottom tonight. Your job is to understand whether this is forced selling or a fundamental break. Those require different responses. Watch how price behaves around $80 to $82. Does it stabilize? Do you see volume drying up? Do you see some buying interest coming back in? Or does it accelerate lower? Does it break through 80 with expanding volume and no support? That's the difference between a technical washout that might find a floor soon and a market that's got further to fall. If you're already holding, you need to decide your exit criteria before you're in the heat of the moment. What price would tell you you're wrong? What pattern would tell you this is more than just forced liquidation? Answer those questions now, not when you're panicking later. Maybe you're on the sidelines waiting for opportunity. That's valid too. In fact, in situations like this, being on the sidelines is often the smart move. You don't have to participate in every move. You don't have to catch the exact bottom. For you, patience is the edge. Historically, final washouts often push into zones like $70 to $75 before pressure fully clears. Now, I don't know if we'll get there. I don't have a crystal ball. But if you look at how these forced liquidation events tend to play out, you often get one more leg down, one more flush, before the real capitulation happens. That flush is usually accompanied by shrinking volume, not expanding panic. It's exhaustion, not fear. When you see that, when you see price drop on lighter and lighter volume, that's when buyers start to get interested. You don't need to catch the knife. You need confirmation that the knife stopped falling. Wait for price to stabilize. Wait for some sort of base to form. Wait for volatility to contract. Then, if you still like the setup, you can enter with much better risk reward. You'll miss the exact bottom. Everyone misses the exact bottom. But you'll avoid catching the trade halfway down, which is way worse. Or maybe you're actively trading volatility. If that's you, respect the environment. This isn't a normal market right now. Spreads widen during high volatility. Your entry and exit prices won't be as clean as they are in calm markets. Slippage increases. You think you're selling at 82, you end up filling at 81.50. Risk management matters more than being right. You can be right about the direction and still lose money if you size too big, or if you don't account for the extra costs of trading in volatile conditions. No matter which camp you're in, the universal principle is the same. Understand the structure before you react to the price. Don't just look at the chart and make emotional decisions. Ask yourself, why is price moving? What's driving it? Is this fundamental information or is this mechanical pressure? Once you understand the structure, you can make much better decisions about how to position. So here's what I want you to answer in the comments. Which type of person are you right now? Are you holding and trying to decide what to do? Are you on the sidelines waiting? Or are you actively trading this volatility? Let me know because I'm curious where everyone's head is at. So here's where I stand. I'm not panicking and I'm not blindly buying. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether $80 to $82 holds into the close after the margin hike actually hits. If price stabilizes around these levels and doesn't break lower with heavy volume, that would tell me the forced selling has been absorbed, at least for now. That doesn't mean we're going straight back up. It just means the immediate mechanical pressure might be relieved. Second, I'm watching for any flush towards $70 to $75 that comes with shrinking volume, not expanding panic. If we do get that additional leg down, I want to see it happen on lighter volume. That would suggest exhaustion. That would suggest the sellers are running out of ammunition. That's a very different setup than a high-volume breakdown where everyone's rushing for the exits at once. Third, I'm monitoring volatility itself. If volatility contracts after tonight, that's information. Markets can't stay in high volatility mode forever. Eventually, things calm down. When volatility starts to drop, when the daily ranges start to narrow, that's often a sign that the acute phase of the move is over. It doesn't tell you which direction comes next, but it tells you the panic is subsiding. Based on my analysis, this move was mechanical, not emotional. It was about leverage, not a sudden collapse in demand. The fundamental picture for silver, whatever you believe that to be, didn't change overnight. If you're bullish on silver because of monetary policy, because of industrial demand, because of supply constraints, whatever your thesis is, none of that changed today. What changed was the cost of holding leveraged positions. That's technical. That's structural. It creates price moves that can be sharp and painful, but it doesn't necessarily invalidate the longer-term case. If history rhymes and silver finds support in the $70 to $85 range and builds a base over the coming days or weeks, the move that follows could retrace a meaningful portion of this decline. But that's not a prediction. That's a conditional statement based on historical patterns. The market has to actually show you that support is holding before you act on it. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Look at the CME notices yourself. Look at the price action yourself. Look at historical precedents yourself. Don't take my word for it or anyone else's word for it. Markets reward independent thinking and punish people who just follow the crowd. If you made it this far, you're the type of person who wants to understand how markets actually work, not just get hyped up on narratives. That mentality will serve you well. The traders who survive and thrive long-term aren't the ones who get lucky on one big trade. They're the ones who understand structure, who understand mechanics, who can look at a chaotic situation and separate signal from noise. If you found this breakdown valuable, share it with someone who needs to see it. Hit the subscribe button if you want more real-time market analysis without the hype. And most importantly, stay sharp out there. Think critically, verify the data yourself, and make decisions that fit your risk, not someone else's narrative. I'll see you in the next one. See you in